Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I am Prashant. With me, my colleagues Nigel and Surabhi. Guys, good morning.
Hi, good morning, Nigel. Good morning, Prashant. Smiles are wide. There's a spring in our step, and we know why. It's Friday, but also because the queues overnight not too bad.
Well, that's right. Trump says he's talking to various heads of various parts of the world. It reminds you when you were in college, right? Are you dating or not? You know, are they actually talking? They're not. One is saying yes, one is saying no.
I didn't meet him.
As dynamic as it is, right? We're meeting later today. We're meeting who?
This is a good one.
Getting
good one.
Friday.
I think you need these kind of analogies to describe what's going on, right? Because it's so bizarre.
Yeah.
One guy says I'm talking, the other says, well, I'm not talking.
And they says talking to who?
Talking to who? We'll play that soundbite out for you in case you've sort of missed the latest. But let me just quickly start from the top. So last night was good. I mean, S&P was up about 2, NASDAQ was up about 2.7%. So these are solid, strong changes that we saw in the US session. Now, confusing headlines with respect to China-US. Now, China-US, why are we concerned about China-US trade talks? Because the US is the number one economy, China is number 2. And, it matters for global growth. At 145% tariffs, China-US trade is halted. And people are expecting that if this does not get resolved, some kind of agreement at least, I mean, things will get worse, way worse, before they get better. They can get better. That's why US-China, what they do is important for global growth. And, of course, I mean, even for India in an indirect way, it matters. Now, yesterday, right, I mean, there were the Chinese Commerce Ministry official essentially said that any reports on developments in talks are groundless. So pretty clear. Now, President Trump overnight, was asked by a reporter about, the fact that China seems to be saying that, well, no talks are happening. And he said, and this is an exact quote, we've been meeting with China. There was a meeting this morning with China. Now, again, I mean, and that's essentially the confusing part. We'll await, and so the last statement was from President Trump, and it's possible that we hear something from China this morning at, over the next couple of hours. We'll see. But this remains the most important talking point this morning. Now, the 10-year yield lost about 7 basis points to about 4.31, and that was a sharp cut. You had the dollar index down about 0.4, 99.43, not very much by way of a change. You had Fed Governor Waller, who said that tariff and trade impact likely greatest on labor market, but will only show up in hard data in the second half of this year. There was another Fed official who weighed in and kind of indicated that, and typically a hawk, but basically said that June is a live meeting. But again, lots of caveats there. Who knows? I mean, it'll all depend on what the data comes through. Oil prices 0.5% higher, $66.5 a barrel is where Brent left off at. Now, South Korea and US have set a framework for a trade deal, which is essentially what Indian negotiators in the US are trying to do, which is broadly set up what they're going to talk about and negotiate, and what is on the table, what is not on the table, and what needs to be discussed. So South Korea and US seem to have done that for now, and trade talks will continue. Trump met with Norway's Prime Minister. They discussed Russia, Ukraine, but there was also a Bloomberg headline which said that the Norwegian sovereign fund will buy more US assets, US equities, etc. And we'll talk more about that as well. It's one of the largest sovereign funds. Just to tie in the levels here, so yesterday the market, of course, seeing about 0.33% cut. It was slightly sideways. We never got anywhere close to the hourly averages, which are support levels. So these are levels. 23,980 is where the 40 hourly exponential moving average is moved up to. And this is the first near-term, short-term support level. Upside level remains 24,546, which is 61.8% retracement of the entire fall. And, support for the Nifty Bank, 54,664, which is the 40 hourly exponential average. Resistance for the Nifty Bank at yesterday's high, day before yesterday's high, beg your pardon, 56,098 and then 56,631. So these are essentially numbers. GIFT Nifty will come up on your screen. And as I said, response from China, etc., will matter for how markets trade through the course of the day today and into the weekend as well, because headline risk really remains quite high. US-China very much right up there in terms of what markets are watching. Surabhi.
Absolutely. And for the time being, markets are feeling good, actually. Yeah. Asian markets are all up and about. And yesterday's Wall Street rally really helped matters as well. The fact that tech stocks took a flight, NASDAQ was soaring higher. Though all was not well. I mean, yesterday it was a lot about tech earnings, and some of that's playing out this morning as well. I'll just come back to Asia in a bit. Asia is the nice shade of green. But yesterday we had, a very different reaction to Intel and to Alphabet, specifically in after-hours trading. Because Alphabet's numbers are great. They have beaten on the top line and the bottom line as well. But for Intel, the numbers were good. Their guidance is very, very cautious. And in the commentary, the Intel CFO said that the chances of a recession in the US have increased, given all the trade uncertainty. And therefore, the guidance is lower than what the street had in mind. The Intel stock is down 5% in after hours. The Alphabet stock is up. So anyway, it's all about tech earnings. In Asia, now let's come to Asia. Japan, South Korea, Hong Kong, all markets are up and about because they've taken off from where Wall Street left things. And if you're talking about some of these trade talks, of course, we're still waiting and watching to see what the Chinese side says, because like Nigel also mentioned, the US is saying it's talking, it's progressing well. China is saying we're not talking at all. We will only talk once first you remove these tariffs that have been levied. So let's see where that goes. In terms of South Korea, the trade negotiations have been underway in Washington. And yesterday, Scott Bessent actually said that they've been very successful. And these talks are moving faster than I thought, quote unquote. So that kind of is giving a bit of a positive leg up to sentiment as well on those negotiations. They're specifically looking to thrash out a deal on shipbuilding, which is very important for South Korea, obviously, and energy, which is really important for the US. So let's see how it goes. Talks will continue. Jameson Greer will take it forward now on the 15th and the 16th of May. Coming to the markets, like I'm saying, it's a broad shade of green all throughout, which will obviously help us start off on a very optimistic note as well. Yesterday, the market did, snap its 7-day winning streak. Bit of a pause yesterday. But the news flow was positive. The fund flow was positive. So no real problems in terms of the India pause yesterday. And given this backdrop, chances are that we'll start higher. We'll, in fact, look at the implied open again in just a bit. The fund flow picture, like I'm talking about, 8,000 crores of buying, 8,200 crores of buying coming in from foreign investors. I looked at the total monthly tally for April so far. If you look at the final figures from the depositories, the number is still negative. FPI flows in April are still down 11,000. But that negative number has been reducing at a very fast pace because of these kind of flows that have been surging through the cash markets. Domestic institutions were on the sidelines. They sold off a little bit of equity, worth about 500 crores. Earnings, and more earnings. We'll get you the details in a bit. SBI Life came out there. VNB growth and the VNB margin is way above expectations. So good showing over here. Tech Mahindra, weak as expected. The top line has fallen a little more than what the market had in mind, but the margin is intact. So let's see. And anyway, the markets moved ahead of the weak Q4 numbers for Tech Mahindra, for the tech sector overall. Axis Bank, not much problem. Margins are actually good. They've improved sequentially. Gross NPA picture is also looking better. So another good set of numbers from the large cap banking space. Let's watch out for this. And today we have a full tally. Reliance to start off with. Maruti, Dr. Lal, L&T Finance, Hindustan Zinc, and let's not forget Motilal Oswal. Capital market stocks obviously in great focus as well. So let's see, pretty busy with earnings, and the global backdrop is not too bad at all, Nigel.
Well, that's right. And yesterday was actually an inside day, which means the high and low of the previous trading session, the Nifty traded within that band. We broke that 7-session winning streak, though. We ended the series on a high, and the Nifty went home with gains of close to around 3% for the past series itself. Now, we kickstart a new series, which is the May series, and the question is, will it be sell in May and go away? Or are the bulls good for more? I think after the last two good series, maybe we should be bracing for more tepid kind of returns in this series itself. So let's see how that goes. The FI positioning in the cash market, well, it's far more optimistic, even in the futures and options space. So the FI's trend is more positive, but the clients are net short, and they are net short for the first time all the way since September, October 2024 or thereabouts. Let's get into further detail on that front then. If you're looking at the index futures, well, the FIs, they're net short to the tune of closer around 25,000 contracts. The clients as well are net short to closer around 21,000 contracts or thereabouts. And stock futures, both of them are net long. But this is after a while that we're seeing both of them are net short on the index. And let's rewind to the start of the October series. You know, you have the FIs at that point of time. Well, their short positioning was only around 20% or thereabouts. The clients, though, the last time they were net short was in October 2024. And this time around as well, they are net short on the index. What's different between October and currently is that at that point of time, the FI net shorts were missing in the system. This time around, you have the FIs that are net short. So a couple of points out here. Clients, net short for the first time all the way since the October series, while the difference between both the May series as well as October series at the start of it is that the net shorts from the FIs were missing. Now, that's the returns that we have seen. You know, the reason we're talking about the October series is because the last time the clients were net short, well, we did see a bit of a, downtick for the next few series. So I'm not saying it's going to happen out there, but the last time the clients were net short, we did see some kind of profit taking on the Nifty, though levels are very different and the euphoria levels as well were very different. So that's the positioning. Now, moving on to, the Nifty open interest. This time around, well, it's a little bit lighter than what we have seen. So if you pull up, the total open interest at the start of the series, well, it's a little bit lighter in comparison to what we saw in the past. Moving to the options data then, we have, a couple of strikes that were active. The 25,000 call, well, fairly active. Out here, there is some out-of-the-money call buying that we've seen. While at this particular strike, that's a 24,300 call, there is some writing that we have seen, 177 rupees or thereabouts. While on the put side as well, we have seen fair bit of action at around that 24,000 odd mark, 24,200 put, 24,100 put, which brings us to the levels. You'll still see this Nifty is in an uptrend till that 23,800 mark gets held out. However, we'll be breaking away once we get past the 24,500 odd mark. So that's a bit of a range down. Lower end of the range and the upper end of the range as well. The Nifty Bank, that holds the key. The 56,000 mark has been a bit of a crucial resistance level. We have almost visited that in the last few sessions, but we have not been able to conquer that. And remember, the RSI on the Nifty Bank, that's still holding above 70, which is technically a bit of an overbought zone. So this is the important mark. The stock that I'm tracking for today is Waaree Energies, because some of those shares that were locked up, including the promoter holding, well, that gets, comes off the lock-in period today. Stock saw some profit taking today. It'll be the stock to watch today because the numbers were good. But because of that technical factor with the number of shares being able to trade go up, we'll have to keep an eye out on this stock.
Okay, all right, got it. Nigel, thanks for that. Overall, looking quite decent as we start off things this Friday. Here's an equity call, and this is actually a slightly cautious one coming in. It's from Vikas Jain of CLSA, who says that uncertainty on global trade is bringing back there is no alternative feeling, the TINA factor, back among global investors towards the Indian market due to its relatively low exposure to global trade. But the recent rally has taken both the Indian equity and bond markets back to stretch valuations. He says these, along with the potential for further EPS cuts, may limit upside. He says they have exited Hindalco, JSPL, SBI Life and Axis Bank. They've added SBI and Godrej Properties to the CLSA India focus portfolio. He says they right now prefer staples, energy, real estate, utilities and banks over IT, pharma, industrials and materials.
All right, some global opinion now. Let's listen into Phil Camporale of JP Morgan Asset Management discussing market outlook, his view on what the Fed will do, respond preemptively or wait for data.
So earlier this year on, first week of February, Treasury Secretary Bessent said that the administration's focus is on rates, and we continue to believe that. And I think April has kind of proven that. We're believers that Jay Powell is going to make it to the end of, May of 2026 and the end of his term. And at the end of the day, if the labor market were to slip, the Federal Reserve will be in play, and I think the 10-year note will provide a positive return versus equity markets that could be selling off. I just think that in a world where growth is slipping, I think that's going to burn out inflation, and the Federal Reserve will be more focused on their full employment mandate. And I think we've heard that from a couple of speakers recently. Fed's priced to do about 3.5 cuts this year, We think that they could start to move in June.
Okay, before we get our first conversation going, let's hear out one more piece of opinion, and this is coming from the Bank of England. The BOE is focused on the potential impact of US tariffs on UK economic growth if there is a slowdown in global trade. That's the word from the central bank's governor, Andrew Bailey. Listen in.
In terms of growth, I'm afraid I do, first of all, in a sort of longer term sense, if you reduce the openness of the world economy, that will have a negative effect on growth. Now, if you reduce trade, you reduce productivity growth and you reduce growth. I think on top of that, there is then, at the moment, what I would call the uncertainty effect. And we certainly see this. I see it when I talk to people in the UK economy a lot. They are worried about just the sheer level of uncertainty now in the world economy, the sheer level of uncertainty in policy.
No retaliation.
Border retaliation would have an effect. Then if there was redirection of trade, I mean, if exports started being redirected into other markets, that could actually be negative for inflation. And then the effect on exchange rates, although for us at the moment, there has been some effect, but it's not been that large.
Okay, well, more opinion as we go along, but let's get the first opinion for you in terms of conversation. Seth Freeman is with us, Senior Managing Director at Glassratner Advisory and Capital Group. Seth, good to have you back on the program. Thank you for your time. How much attention should we pay, Seth, to the S&P? Sometimes up 2, sometimes down 2. I mean, generally a manic reaction because you're getting sort of whipsawed either way because of all these headlines. And this is stark what has happened over the last 24 hours. China saying we're not talking. Trump on the record, on camera saying, well, we've had a meeting.
A lot of contradictions, and you're absolutely right. We've got these big downswings, 2 to 3%. And then we hear that Trump does not intend to replace the Fed chairman, and the market goes up 2 to 3%. It's all part and parcel of this real uncertainty that we have here, and it is kind of worse in terms of adding to the chaos by giving out different signals. Yesterday, President Trump was saying, as you said, he expects a deal with China, and China says they're not relenting. There is no deal. So it's very complicated, and we have a lot of things going on besides the policy chaos in terms of war, Russia's behavior with Ukraine, now Pakistan and Kashmir and India. We have a lot of extreme turbulence and crisis going on here. On the economic crisis side, this was basically, unfortunately, manufactured by one person in Washington, D.C., where I happen to be today.
Seth, hi, great to have you on the show. And it's really important, it's pertinent that you bring that up, because I don't think, and as a foreign watcher, you obviously are watching those headlines. I think a lot of people here in India are not paying enough attention to the fact that we could have a geopolitical situation play out very soon right here in our backdrop. Because if you look at the national press in the country, I mean, the entire nation's focus is squarely on India's response next. Maybe not so much in the Indian stock market right now. So I think that's a risk that maybe has not been priced in. But let's actually expand on that. Two things. We just read out a note from CLSA, that's a view on the Indian market, saying right now India is going up because of the TINA factor. That's why we've got the foreign flows back. But the risk could be that, earnings don't support. And the other risk is the one you just mentioned, geopolitics. So how are you looking at India?
Well, I say this, I think, every time. My long-term view is very sticky. And, especially both for domestic investors and international investors, the India story, even after the 20 years I've been involved, is still a very long story. That said, things don't go in a straight line, as we know. And, it's just a mess. At this particular period of time, Modi was visiting Washington. A few days later, 26% tariffs were announced. There's been a lot of news sort of educating U.S. consumers about India's 100% plus duty on foreign automobiles. But I think that in the midterm, late near term to midterm, India is going to be a beneficiary in kind of a nice little jump because of the geopolitical issues with China. And to the extent that there are manufacturers and exporters from India that can take the place of Chinese goods, there's a real opportunity there.
Hi, Seth. Good morning from here in India. If I heard that right, I think you're in Washington, right?
I am. I'm in Washington, D.C. There are the World Bank meetings, but I'm actually, very active in corporate restructuring and distressed. And there's a major bankruptcy attorney conference here in Washington. I'm attending.
It's a lot for staying up for us, Seth. Since you're where all the action is at, tell us what kind of feedback are you receiving? On ground, how's the U.S. economy doing? We're getting very, very mixed signals out here, reading from what data comes up. And also, what's the feedback with regard to India? We hear the feedback we get is that the globe believes that India will emerge stronger, post this entire trade tariff scenario playing out. Is that the feedback you're getting on ground as well? Higher amount of interest for India?
I think that the news is biased positive towards India. It's still very interesting. There is not as much what I would call kind of mainstream following of India, the Indian economy. Now, most Americans have been touched by the IT sector in India. But many U.S. investors and just regular U.S. citizens aren't so familiar with other aspects of India's robust economy, and it is getting more attention in the news. The situation here is very complicated, partly because we have sustained high mortgage rates compared to during COVID when they were very, very low. And during COVID, housing prices went up quite abruptly. The U.S. is a major consumer economy, and consumer debt levels are at a very high rate. And also the credit card users are experiencing a lot higher default rates. So there's not as much open to buy as in previous, just the last 2 or 3 years. During COVID, a lot of Americans stayed home. They weren't spending as much money on commuting and so forth. So people were buying a lot of stuff, and that's really come to a halt. In our restructuring practice, we're seeing many kinds of businesses that flourished during COVID really having a difficult time because they geared up. They also had PPP money, CARES Act money related to the COVID pandemic, which businesses spent and used up.
No, absolutely. And point taken. Seth, we'll leave it there for now. You have a good conference and wish you all the best of luck for that. And look forward to our next one. Thank you very much for joining us here on CNBC-TV18. We'll take a quick commercial break here. Let me quickly run you through all the interactions which are lined up over the next 2.5 hours. Siddharth Khemka, Motilal Oswal Financial Services, 8:30. We'll talk stocks. 9 o'clock, we'll get an exclusive chat with the experts at Nomura on the global macro scene. 9:20, Rahul Arora of Nirmal Bang Security Equities will be with us to talk about markets. 9:30, Loda will be with us on their fourth quarter numbers. Anish Jain of Macquarie Capital talking to us at 9:40 to tell us what to expect from the auto space. And towards the end of the program, it's the Economy Lata in conversation with Krishna Srinivasan of IMF on the steep cuts to Asia's growth forecasts by their organization.
Time to slip into a break. You come back, we've got a lot of stock-specific action to track for you. We're looking at Axis Bank, Tech Mahindra, SBI Life, LTTS, Emphasis. All of them will be reacting to positive news flow. Add to the list, the Analyst platforms, Macrotech Developers, All of them react to positive news, while 3 stocks react to negative news flow. That's SBI Card, Cyient, and IEX. Welcome back. Hope you're having a good morning. Well, as promised, our research team is standing by to take you through all the top stocks that we're tracking for you. Good morning, ladies and gentlemen. Well, Abhishek, you go first. Tell us, how was Axis Bank's numbers?
Well, Nigel, Axis Bank numbers were a mixed bag. Business momentum is softening on a YOY basis. So if you take a look, deposit growth of 9.8% YOY is perhaps the second lowest that you are seeing in last 16 quarters. But sequentially, the deposit growth was good at 7% sequential growth. It was one of the best in last 8 quarters. However, advances growth was at just 7.85% YOY, which is the lowest in last 16 quarters. And sequentially as well, it was just 2.5%. So you saw weakness over there in housing portfolio as well as the auto loans, which actually declined on a sequential basis. Now, cost to income ratio or operating efficiency is the worst in last 5 quarters. Cost to income ratio was at 47.8% versus 46.2%. The good part in the result was the asset quality. So slippages came in about 4,800 crore, down about 11.5% sequentially. Asset quality continued to improve. So gross NP ratio is the lowest that you are seeing in last 39 quarters at 1.28% versus 1.46% in the previous quarter, and that's thanks to write-offs. Write-offs have been one of the highest in last few years. Net interest margin improved for them by 4 basis points on a sequential basis to 3.97%. Risk-weight asset to advances ratio, now that's the highest that you are seeing in last 5 quarters, coming in at 111.4% versus 109.8% in the previous quarter. So PNL versus ARPOL, the NI is in line with ARPOL. However, lower provisions have aided the PAT to be ahead of ARPOL. So numbers seem to suggest that Q4 was a tepid quarter, but stock has valuation comfort as it's trading at price to adjusted book value of 1.8 times FY26. Back to you.
Okay, all right, got it, Abhishek. Thank you very much for that. And that's Axis Bank. Let's now find out how Tech Mahindra fared. Reema, good morning.
Well, revenue was a miss compared to consensus expectations, margins slightly ahead. On the top line, the company's revenues declined by 1.5% quarter-on-quarter, worse than what the street was anticipating. The company said delay in deal closures, a renewal deal in high-tech space got delayed, which led to the sequential decline in the top line. Margins improved by 30 basis points to 10.5%, and the deal wins were fairly robust, up 7% sequentially, 60% higher year-on-year. The company, remember last year under the new management, had set out a vision FY27, where they said that by FY27, they want to get to margins of 15% and above industry growth rates. So the company is reiterating that despite the macro uncertainty. They said in FY25, we built the base. FY26, things will stabilize, and FY27 is when they will reap returns of that. But in a nutshell, top line a bit subdued, margin performance continues to be good.
All right, Reema, thank you very much for that. Well, let's talk about SBI Life, and I think numbers were super strong. Second quarter in a row. Yash is here with details. Yash, morning.
Well, contrary to the street expectation of weak numbers from SBI Life Insurance in the fourth quarter, the company has been able to deliver a complete inverse of that as far as, comparing the numbers with the street expectation is concerned. With respect to new business premium, it's come as a slight beat. Total APE has come as a big beat to what the street was anticipating. Retail APE, the numbers are in line with street expectations. Value of new business, there's a big beat which the company's been able to deliver. And finally, the best for the last, a strong margin performance, which is much ahead of what the street was anticipating. Now, let's get into individual numbers. As far as new business premium is concerned, the numbers have been weak, but as I said, much ahead of the street estimates. The new business number is down 24%. The number that has come is 9,324 crore rupees. Total APE, the street was anticipating a contraction, but there's a growth which has come of about 2% at 5,450 crore rupees. Retail annualized premium equivalent, that has grown by 8% at 4,800 crore rupees. Value of new business, as against a contraction which the street was anticipating, the number has grown by about 10% at about 1,660 crore rupees. And finally, as I said, the best for the last, margin is up 216 basis points, coming in at 30.46% as against 28.3%.
Thanks a lot for that, Yash. Well, Rima, though, is joining us to tell us about LTTS as well as Emphasis. Numbers look good, Rima?
Well, for LTTS, no. For Emphasis, yes. So on LTTS, the company's top line missed expectations. The street, given the acquisition of IntelliSwift that they'd done, the street was hoping for, or the consensus was about a 13% plus top line growth. The company delivered 10.5%. Again, the problem is the macros. The company in the conference call said ramp up of deals got delayed, some deal closures got delayed, and that impacted the top line. That said, they've said FY26 will be a better year than FY25, and they've reaffirmed their medium-term target of $2 billion in deal wins. In terms of revenues. Onto the deal wins, highest ever. TCV closed in Q4. That's a positive. Margins have come down, and the company holds on to its margin guidance of 16%. Emphasis has had a very strong quarter, the highest quarter-on-quarter revenue growth in 3 years. The top line is up 2.9%. TCV, that's the deal wins highest in the last 7 quarters. The pipeline is at record high levels, and the company, in terms of a margin guidance, is talking about 14.75 to 15.75, and they're saying they will be industry leading in terms of the top line performance in FY26.
Okay, all right. So Emphasis is definitely a stock to watch. Let's see, it could maybe really pop, given the numbers that you just described. Thank you for that, Rima. Back to Abhishek. SBI card, unsecured lendings, poster child. Abhishek, how are the numbers?
Well, credit cost continues to remain elevated for them. Take a look at the key things that they have reported in Q4 FY25. The quarterly spends are up just 11% YOY and 2.5% quarter-on-quarter. But receivable per card, which is down both YOY and quarter-on-quarter, suggesting that the spends have actually continued to decline. Card receivables, that is AUM growth, is at 9.8% YOY and close to 2% sequentially. They have been able to improve their net interest margin both YOY and quarter-on-quarter, and this for the first time in many quarters that you are seeing such an uptick, because of the fact that 50 basis point increase was seen in yields on a sequential basis. However, the annualized credit cost continues to remain elevated at 9% when compared to 7.6% in the same quarter last year and about 9.4% in the previous quarter. The revolver rate continues to remain flat at 24% when compared to YOY or quarter-on-quarter. The NI growth is 7% YOY and about 2.3% sequentially. PAT is down 19.4% YOY, but it's increased by 39.4% sequentially. So in the con call, the management did say that, a credit cost of 6 to 7% range is quite far, and they do not expect it to be achieved in the near term. That could put the pressure on stock and trade today. Back to you.
All right. Abhishek, thank you very much for that. Back to Rima, Scient and Tanla platforms. Rima.
Well, Tanla continues to have slow growth, but there is a pickup compared to the prior quarters. And the key reason is OTT, that's the WhatsApp platform for communication, has started delivering. So WhatsApp revenue growth was 31% quarter-on-quarter and now accounts for nearly 29% of its overall revenue. Margins and profits on the flatter side are fairly stable. Scient, on the other hand, has had a disappointing quarter, both on the revenues and on the margins, and the company is not giving a guidance for FY26. Scient is a company which gives you a quantitative guidance. This time they're abstaining from it. They say that while there are some uncertainties in the near term, we are working very closely with our customers in navigating through the current challenges. We expect this to last at least through the first half of FY26. So Scient missed on Q4 and no FY26 guidance, and they expect the uncertainty to impact them in the first half of the year at least.
Okay, all right, Rima, thanks a lot for that. Well, let's hop across to Vinny. Vinny's tracking a couple of counters for us. Vinny, IEX and Macrotech, how were the numbers?
So for IEX, it's a mixed set of numbers that's coming in Q4 FY25. We're seeing a bit of a miss on the revenue front, and that is mainly due to the lower per unit transaction fee, is what Motilal Oswal is highlighting. Other than that, profits were in line with estimates. But in terms of volumes, for the full year, when you look at it, which data has already come previously, 47% growth in terms of volumes for FY25, and for Q4 Q4, the volumes have seen a 2x growth on a year-on-year basis. So for IEX, what's important is the volumes data that comes out as well every month. And other than that, in terms of regulations, in terms of the market point of view or market coupling, are more important data points. As of now, we're expecting a bit of a red coming in on the screens because there was a miss in terms of the revenue growth for the company. Other than that, Macrotech Developers Q4 operational update had already come in, so we know in terms of revenues, profits, collections, what to expect. But for FY25, just on an overall basis, pre-sales saw 21% growth, which was surpassing the guidance that they'd given for FY25. Collections was also quite good at 14,490 crores, and additions in terms of new projects, that was also about the FY25 guidance. For FY26, they've set a pre-sales of around 21,000 crores, new project addition of around 25,000 crores GDV is what they're talking about. So guidance also seems to be good in terms of the growth strategy that are given in the past, and we're expecting a bit of a green on the screen today.
Okay, all right. Got that, Vinny. Thank you very much for that. Let's quickly recap our list of stocks to watch then. The ones that have positive news flow around them are Axis Bank, Tech Mahindra, SBI Life, L&T Tech Services, Memphasis, Tanla Platforms, and Macrotech Developers. All of these on earnings, of course. Stocks with negative news flow, SBI Card, Cyient, and IEX. Okay, so that's lots of stocks and lots of earnings. Let's now move on to commodities and find out what's happening. We have Manisha joining in with the latest. Manisha, good morning. So are they talking? They're not talking? Who's talking? Who's dealing, not dealing? Beyond comprehension. But you tell us, what did the commodity markets make of all this China-US tango?
Oh, well, absolutely. So it'd be the skepticism over this US-China trade deal is exactly the reason that you have the gold prices coming back in favor. We did see prices go decline to 3,270 day before yesterday, but we are trading back above $100 on the higher side at 33.50. Still off those all-time highs of $3,500 an ounce, but that is also because the dollar index seems to have gained a bit. There are conversations that U.S. perhaps is closing or nearing a trade deal with countries like Japan and South Korea. That progress has led to dollar index coming back, and that's weighing not just, or rather capping gold gains, but it's also weighing on the crude oil prices, which are headed for a weekly decline. Crude also is bothered with the oversupplies coming in from OPEC and allies. In the metal space, you have copper prices off 3-week highs. There's a bit of a decline that we've started Asia with in sense of aluminum and zinc as well. Silver prices also are off 3-week highs. Steel rebar China is trading at a 7-month lows right now. There is increase in supplies when it comes to steel, but the demand is quite uncertain, and that really seems to be weighing on in case of ferrous metals there. In all of this market, there are only a couple of things which I can see trade in the positive in Asia right now. One is coffee, which has gained 5% overnight. The other is cocoa, which has gained up by 2% overnight. Apart from that, most of the commodities either flat or trading with marginal decline.
All right, Manisha, thanks a lot for that neat wrap. For the time being, we slip into a short break. On the other side, we have Sid Khemka, Motilal Oswal Financial, who will be joining in for some fundamental stock talk. Stay with us.
Welcome back. We're anticipating a positive start. Let's get the implied open up on the screen as well, because Asian markets are really feeling quite good this Friday. There we go, 115 points higher. That's the indication. So the bull charge is all set, or perhaps all likelihood it will continue. We have Siddharth Khemka joining in, Head of Research at Motilal Oswal Financial Securities. Siddharth, thanks very much for being here. Happy Friday. Lots of numbers have come through. You pick one. The best of the lot this week, because of which you think, it's a strong case for a buy.
Yeah, definitely. Good morning and happy Friday to you as well. If you look at a lot of numbers across sectors, across the segments, what I can highlight clearly from yesterday's numbers is Laurus Labs consistently showing sharp improvement. I think second consecutive quarter of better than expected numbers. The CDMO and FDF has been driving the earnings. FY25 ended on a very strong note. What we see is that after 3 years of deteriorating earnings, finally Laurus has ended FY25 on a very strong note, 92% growth in PAT, and especially the segment CDMO where which were impacted because of the higher capex, that is now started to showing improvement with asset utilization and higher launches in the domestic formulation segment. So I think numbers are there to be seen, but we believe that things are turning around, and we see a revenue growth of 18% on back of margin improvement. We see a strong PAT CAGR of 57% going forward, and hence we believe that over the next 2 years, this could be a stock to watch out for. We have a buy rating and a target price of 750 on Laurus Labs.
Okay, all right, 750 is the target price out there. Hi Sid, good morning, good to see you in. Let's focus on some of those frontline names then. You have TechM as well as Axis Bank that reported set of numbers. Both of them are expected to react favorably to the set of numbers. What's your take? Axis Bank, I think valuation-wise, it has some support and the numbers look pretty good as well.
Definitely. Good morning, Nigel. Good to see you. So I think no bad news was good news for Axis Bank, and that is something that the market has should like. Overall numbers, I think, are in line with our expectation. However, we saw some slippages and NPAs improving, and I think that is something that the street will definitely like. The overall view is that margins have expanded 4 basis points, asset quality improving, and NPAs under control. So overall, very good set of numbers. Stabilization is seen in the credit card portfolio, and overall, we believe that is on a steady recovery path. Hence, we believe that it could be the stock where over the next few quarters things should improve while we have a neutral rating, but the view is turning gradually positive on Axis Bank. I think Tech Mahindra, pretty strong outlook out there. Margins improvement were better than expectation, and that led to marginally better than expected net profit. The company is taking a transformation and diversifying across other segments, so BFSI, healthcare, those segments, and that is driving the strong growth. We are seeing very strong deal wins. 42% increase in deal wins in FY25. That has been the strongest among the large and mid cap. Obviously, the base is lower, but definitely shows that the transition is helping, and margin improvement plan that is also on track. The company is targeting FY27 margin aspiration of 15%, and with the structural initiatives, the diversification, pricing improvement, automation, and improving utilization, we believe that this is now achievable, and hence we believe that this could be one of those stocks where we could see a very strong earnings growth in the next 2 years, and because it's a transformation-led growth and not too much dependent on the discretionary spending. Hence, what we are factoring in are 27% earnings CAGR over the next 2 years, and believe this could be one of the topics within the large tier 1 IT companies. So again, we have a buy rating and a target price of 1950, a good 35% upside from current levels.
All right, that's interesting, Sid. Coming back to you, now Reliance will report numbers for its fourth quarter today. Let's get and set expectations in terms of what the street is previewing here. Reema's got those expectations. Reema, over to you.
Steady and strong, that's the way perhaps to describe the expectations from big boy Reliance Industries earnings in the March quarter. Now on the top line, about a 1% revenue growth, 2.42 lakh crore. Year on year, the revenue growth would look more at 2 to 3%. EBITDA is seen on the flattish side. So 43,800 crore on the EBITDA, which means EBITDA margins of 18.1%, and profits are seen lower slightly, just about 2%. Now let's talk about the individual businesses. So Jio is going to be a growth driver. Jio is going to have another good quarter because the July tariff hike benefits will continue to flow through. Oil and gas is likely to be a bit subdued on account of lower volumes, and even retail is likely to see some sequential softness. So if you remember, Q3 is typically a very strong quarter for retail on account of festive season. So therefore, quarter on quarter, the Reliance retail EBITDA could be down, but year on year, it's still likely to report a growth of about 10 to 11%. And O2C is likely to have a mixed quarter. Cracks are slightly lower, but on account of better sourcing, perhaps the gross refining margins for O2C could be up. Now, the stock hasn't, year to date, it's up close to about 6%, but from its 52-week high, the stock has fallen close to about 20%. But bear in mind that a peer like Bharti Airtel, at least a peer in the telecom business, has outperformed Reliance Industries by 50% in the last 1 year. So investors are saying at some point, at least, there can't be so much disparity between Bharti Airtel and at least the geo valuations of Reliance Industries. But what is dragging Reliance Industries down? One has been the slowdown in retail. So what investors are closely watching is when will the retail recovery come through? What does the company guide about that? Secondly, reduction in their capex intensity, which means more free cash flow. And thirdly, monetization. Is a geo IPO coming? What do they talk? What do they say about that? What can they guide about potential monetization? These would be a few big things that are top of mind for all investors. That's the standard disclaimer from Reliance Industries from our channel.
All right, Rima, thank you very much for that. So that's the Reliance preview, and numbers will come out as always later today. Sid, any thoughts, any perspective on RIL stocks? Of course, not done very well over a long period of time now. What is your sense?
Definitely, I think, Prashant, if you look at the core business, pretty flat. Only the telecom business, which will see some growth and improvement on back of the ARPUs. The retail business is again, I think, witnessing a slower growth. So net, I think the overall expectation is a 5% Y-on-Y decline in consolidated net profits. The key question to look for is definitely how and when the capex intensity will come down, and that will lead to improvement in free cash flow generation. Last time we saw sharp re-rating in Reliance was when their capex had ended and they turned net debt positive, generating a lot of free cash flow. So that is something that the market will definitely look forward for. The second most important thing is the value unlocking whenever the Jio platform will get listed. I think that is something that the market will get excited. Core business, I think there are too many moving parts, and that leads to a kind of not a great outlook out there. As you see, Bharti Airtel has been consistently outperforming with the ARPU improvement, free cash flow generation, but the same valuation treatment may not happen, is not happening in Reliance, and I think that is what is kind of because the capex intensity in other businesses is something that the market is not looking very positively at.
Okay, all right, Siddharth, stay on. We do have to take a very quick break. We'll come back on the other side, keep talking markets, get you some more stock ideas, and also get you the latest on the Pahalgam situation. Welcome back. Let's just take a bit of a breather from all the market commentary and look at the all-important national story. In the aftermath of the Pahalgam attack, India has sent a formal letter to Pakistan stating that the Indus Water Treaty will be held in abeyance. Pakistan terms it as an act of war and has suspended all trade with India and even closed the Pakistani airspace for Indian airlines. Let's bring in Parikshit. Parikshit, hi, morning. I mean, this is important to note because there is an escalation very clearly. And, the Pakistani response is also, very, very far from measured. What is the latest?
Well, we have seen Pakistani army and rangers opening fire at certain points along the LOC. Now, this has happened soon after the Pahalgam attack. India has been responding effectively. So far, the Indian Army says no casualties have been reported. And even as far as violating the ceasefire or firing across the LOC, these are things that Pakistan has done intermittently over the years. Now, as far as military drills are concerned, India has stepped up military drills. In fact, all of yesterday, very extensive and complicated military exercises were carried out by the Indian Air Force. This was called Akraman military exercise. Sukhoi jets were moved from all parts of India to carry out these complex maneuvers. The Indian Navy test-fired a medium-range surface-to-air missile in the Arabian Sea from INS Surat. We've got the Army Chief General Upendra Dwivedi, who will be leaving for Srinagar and Udhampur to review all security situations and meeting top military commanders in the region. You were right when you said that the Indian government has issued a formal letter to Pakistan putting the treaty in abeyance, saying that sustained cross-border terror makes it impossible for India to live up to its obligations under the treaty. At the same time, a lot of support coming from India, from world leaders, President of France, President of Egypt, King of Jordan, PMs of Israel, Japan and Italy have called Prime Minister Modi, and all world leaders have been expressing solidarity with India. So clearly at the Home Ministry, at the Defense Ministry, at the External Affairs Ministry and the PMO, at multiple levels, plans are being chalked out to retaliate against Pakistan.
But Richard, I know completely unfair question, but there is, of course, a fair bit of focus on whether this will escalate in a military way. Anything you're hearing?
Well, in the past, when there have been terror attacks from Pakistan, such as in Uri, in Pathankot and other places, India has carried out limited, calibrated strikes in Pakistan. We saw that Balakot also, where there were Indian Air Force jets, which carried out attacks on Pakistani terror launch pads. So this has happened earlier, so one cannot rule it out. What the opposition is saying this time, that yes, there was a unilateral Balakot strike that you had carried out. Possibly the response can be something more this time around. The Prime Minister has sent out a very, very strong message saying that we will find those terrorists wherever they may be at the ends of the earth. We will retaliate in ways that no one can even imagine. So clearly the political will is strong. Yesterday in the all-party meeting, everyone, including the Congress party, said they will fully support any action that the government takes. So India has to now act at a time and place of its choosing. There possibly will be some response, military response, but it's going to be a calibrated response is the sense that we get from what has happened in the past. But clearly arrangements are being made. We can see a lot of military drills being carried out, but it's very difficult to say in a certain fashion as to when this would happen.
Absolutely, and it should be difficult to say as well, right? I mean, it should be, as you said, a time and place of, our choosing or the government decides to do. Parisha, thank you very much for that. That's helpful context in terms of what's going on. Now, Pakistan has responded with a slew of retaliatory measures, including closing its airspace for Indian planes. Now, Madhya is joining in with what this would mean for, Indian Airlines. Madhya, take us through it.
Airlines like Air India and Indigo have already issued advisories alerting passengers their flights to Middle East, US and Europe will get impacted as they will have to take an extended route. So as I said, international flights from India mainly to US, Europe and Middle East destinations will see an impact as airlines normally pass through Pakistan's airspace. So what are the alternatives? Indian Airlines have tried the alternate routes in the past as well. For example, in 2019 after the Balakot airstrike when Pakistan had closed its airspace. So we spoke to a few pilots who fly on these routes on a daily basis to understand the impact. When the Pak airspace is not available, what airlines do is reroute flights further south of Pakistan and then crossing over Oman, UAE and Iran to enter Europe. So this will not change much for flights flying from Mumbai and South India as they anyway fly from south of Pakistan airspace. So they will just need a slight deviation further and that will add about 25 to 30 minutes more to their flying time. The major impact will be for flights from Delhi which use the Pakistan airspace to fly to Gulf, Europe or US. So these flights will now do a full detour to come to south of India and then fly upwards to reach Gulf and Europe. That will mean an additional 2.5 hours of extra flying time. Then flights from Delhi to US may also have to stop in Europe and then leave for US as the aircraft won't have a longer range. That would mean nearly 4 hours of extra time including the stopover. So in 2019, Air India flights stopped at Vienna and Stockholm and then proceeded to US destinations. This is not just about extra time. This will mean rescheduling flights, burn extra fuel, deploy more crew, eventually pushing the operational cost for airlines.
Thanks a lot, Madhya, for joining in and giving us that quick update. For the time being, we slip into a short break. You come back, we'll get our technical experts who will be joining in. Mitesh as well as Shrikant are waiting for us. Welcome back. Well, let's focus on a few more stocks. Sid Kemka still with us. Sid, what are you making of Vare Energies? You know, the stock was being ruled out. It went all the way down to around 2,000 rupees or thereabouts. And then the results look very, very good. And what's startling about those numbers is they are guiding that FY26, the EBITDA number will be 5,500 to 6,000 crores. That's nearly 70% higher than what they delivered in the past year. But today we have the lock-in period that opens up for a lot of shareholders, including the promoters, so they will not sell. But what do you make of the counter at these levels? The street is totally divided.
Yeah, Nigel, I think definitely it's a story worth. So it's just a company with a lot of promise, and they have also started delivering. What happened was that valuations hit out of the roof, mainly on the back of hopes that US will be a key market for them. They have opened the manufacturing capacity there as well. But with Trump coming back into power and not focusing that much on renewables, I think that is where the sentiments went bad and the valuations kind of crashed. I think overall, renewable as a space looks very promising, and I think they would continue to deliver strong growth. The focus should be on companies which are more focused on India as a growth story, because I think India continues to have a focus on setting up renewable energy, be it solar, be it wind, be it hydro, or for that matter, now there is a lot of focus on nuclear. Coming back to Wari, I think it will remain mixed while the earnings delivery will continue. Clarity from the US in terms of the US renewable policy, that would only strengthen or reaffirm the market to give a higher valuation to Wari Energy.
Okay, that's a take on Wari.
There's some news-based flashes on the bottom of the screen.
China, exactly. I guess that's the reality of economics that starts hitting countries and, on tariffs. Now, China seems to be saying, that's a Bloomberg story, China seems to be thinking of climbing down on some tariffs that China had imposed on US imports that are coming into the country because of rising costs. So let's see.
They're talking then.
Maybe someone spoke to someone.
Some communication.
Okay. All right. On that note, let's move on. I think we have our technical experts with us. So let's quickly get some trading ideas going for this Friday as well. Mitesh as well as Shrikant. Good morning to both of you. So Qs are very positive across Wall Street, across Asia. Implied open is telling that we'll probably start 100 points higher. Mitesh, let me come to you first. What would you do? Nifty, Bank Nifty, individual stocks. What's the best trade?
Good morning. So, we've been maintaining that this is a market which is positively biased, and buy on declines is the right way if somebody wants to enter afresh. And that remains the idea. I think, you will possibly look for some kind of intraday dips. Now, today, the GIFT Nifty is clearly indicating a positive start. So today, you might or might not get an entry into the index. But for people who have long positions, I think closer to about 24,500 is where I think some supply might emerge. So that's the first target for people who want to take some profits off the table. In case you get a dip, then I think the entry point is slightly lower because we have had a very fast run up. So it's closer to about 24,000 odd level. So I'm not sure we'll get it today, but that's the level to keep in mind. Similarly, on the Bank Nifty, I think I'm looking at a target of all in excess of 56,000.
Got that. Gentlemen, morning. Shrikant, what about you? How are you looking at things?
Good morning, Prashant. Good morning, Surabhi and everyone. See, like Nifty, I'm seeing a market to consolidate within the range of 24,400 and 24,200 on the downside. It is rejecting to cross the level of 24,400, but yes, on the dismissal of that, we could see some more short covering in the market. So above that, the chances of hitting 24,600 would turn bright. But if we consider the broader pattern of the market, the way the market has crossed the level of 23,800 in a very short span of time, one thing is very clear that the markets are heading to surpass the level of 25,000 eventually. So in case if there is any dip, as Mitesh said, it will be an opportunity to take some contra bets in the market. And at these levels, we need to be more and more stock specific till the markets are not crossing 24,400.
So the consensus is buy the dips, right?
Yeah, absolutely. I think we should look for adding. See, even IT stocks, there also we are seeing some value buying sort of interest in the market. But yes, this time BFSI, FMCG, I think they should do really well, even from current levels.
Got it. Okay, all right. Mitesh, what about your individual stock picks?
Yeah. Morning, Nigel. I have buys on Dalmia Bharat with a stop at 1949, just below 1950, and a target of 2040. Inox Wind is a buy with a stop at 175 for targets of 192. Persistent is a buy with a stop below 5100 for targets of 5280. And Ultratech Cement is the final buy call. Keep a stop below 12,000. Look for targets of around 12,600.
Okay, all right. A couple of cement names in there. Got that, Mitesh. Shrikant, what about you?
Yeah, Nigel. Yes, commodities, specifically metals, they are participating whenever there is a rally sort of trend in the market. So for the day specifically, we like JSW Steel, which is around some 930, it is around 1040-44 levels. From here, the stock can move to the levels of 1120 or 1130 sort of levels. It is very close to its breakout level. So it's a buy at current levels with a stop loss close to 1010. And the other stock on which we are bullish is Reliance Industries. The reason is because it is again very close to its breakout level. And today, in case if we see the market is sustaining about 24,400, then we could see some short covering in Reliance also. So about 1,300, the stock can move to the levels of 1,350 or 1,360. At this level, again, it's a buy with a stop loss at 1,280.
Okay, all right. Gentlemen, thank you very much. We'll come back to both of you in just a bit from now. The pre-open is now kind of more settled, 50, 60 points higher on the Nifty, 76, 70, 80 points higher on the sensex is what we have. Now, global macros and what will happen really in focus. Markets, of course, in wait-and-watch mode as they wait for some kind of resolution to tariffs and this trade war. I spoke with the top sort of global macro team, markets team at Nomura. So this is Rob Subramanian, who's the global sort of macro head. Craig Chan is head of Forex strategy. There's Sonal Verma, India economist, and of course, Sayan Mukherjee as well, who heads India equity research. Just want to play out some portions of what they told us with regards to what you should expect in terms of the roadmap for these trade deals and how markets will behave in the interim. Listen.
I don't think they'll be done quickly. I think trade deals take a very long time to do. Okay. I think the Trump administration will try to dress up some quick wins with some close allies and hopefully try to get some tariffs down. But, you know, our view is that once tariffs go up a lot, and they have gone up a lot, we think the effective rate's 21%. They don't tend to come down that quickly. And so our baseline is tariffs are going to stay up pretty high. I think China has quite a bit of leverage over the US, and that trade tension will continue. And ultimately, Trump wants tariffs for revenue as well. So, you know, tariffs are going to have a big macro effect on the US economy and economies everywhere this year is our bottom line.
So with China, we've been hearing what we've been hearing over the last 48 hours. Should we read this as a bit sort of conciliatory, tempering things down a little bit? Or is that reading into too much? I mean, things could change. We could hear something different over the coming days. What's your sense?
Well, look, right now, US tariff on China of 145%. I mean, essentially for a lot of trade between US and China, it's essentially stopped.
Correct.
So there will probably be some coming down. But the point I'd make is...
So between 10 and 145, there's
a big range, right? So
and Trump was, before elections, said 60%. So will we get down to 60? What, I mean,
we could get down to 60. And that has been our kind of a longer-term baseline, around 60. But the point we'd make is that's still extremely high. And that is going to lead to a lot of, I think particularly for the US, a lot of inflationary effects. And it's going to hurt growth. Rest of the world, it's a different impact. It's more of a demand shock for the rest of the world, lower growth and less inflation. So there's going to be also a disconnect between central bank responses. We think the Fed is not going to be cutting rates quickly because of the inflation. We have the first cut in December. But for other central banks around the world, there's a lot of room for cutting rates.
You're saying that foreigners, and especially central banks, are selling US bonds. I mean, that has been happening, Japanese especially.
So we haven't seen it in terms of central banks. Okay. The data is actually
so maybe investors,
mixed. It's actually quite mixed. But you have on one hand the Treasury data, which shows you there's some direct selling from Europe. There's some direct selling that's coming from, let's say, China, Asia, ex-Japan as well. But then you have the safe haven, or the tax haven, should I say, places where you have seen actually buying. So it's a bit of offset. There's no consistency really about it on the central bank space. But certainly on the private side, it looks like something is happening there on the actual asset unwind.
I think that's the interesting thing. I think the central banks around the world have been diversifying away from US dollars, their reserves, for a long time. The new interesting thing is the private sector. Private institutional investors, big lifers, pension funds around the world, are they starting to diversify away from the US?
And the reaction, what we saw was interesting, right? Usually when stocks go down, I mean, bonds go up. But here you had a situation recently when everything was getting sold.
Yeah, long end US Treasuries, equities, it was basically almost get out of the US.
So that phrase US exceptionalism, are we at the end of it? What's your sense?
I mean, I wouldn't push it that far away at the end. I would certainly be saying that it's fading, right? That the evidence we're seeing is that it's fading. But at the end is still quite, I think of a push. It's a push to say that.
Sonal, let's come to India. It seems like we're first in line to get a deal. Would you agree?
Hopefully. I think we definitely have a head start. We started the negotiations ahead. The terms of reference have been finalized. India is a strategic ally. Now, deals take time. Agriculture is a politically sensitive subject for us, but there are other aspects of the agreement on the industrial tariff, parts of the non-tariff barrier, buying more of US products, which can easily be done. So I think if we can get the 26% reciprocal tariff down before the deadline, and our tariffs are lower than our competitors, then really in this world, what you're looking for is a relative advantage. And I think
will we have that relative advantage, Sonal? Because others also will negotiate, right? Others will also, for example, competitors in various industries like Vietnam, Cambodia, they'll also want to sort of lower tariffs, their respective tariffs, right? So it's all relative, as you said.
So I think most Asian countries are trying to negotiate with the US. The question is whether what they are offering will be acceptable to the US. One part of the deal is buying more of US products. But for countries like Vietnam, Cambodia, transshipment of China products has been an important reason for the reciprocal tariffs. Also, these other aspects of non-tariff barriers or whatever we want to call them. So, and right now we are seeing China trying to, also talk to Southeast Asian countries. It's putting Southeast Asia in a more difficult position in terms of choosing between US and China. I think for India, it's a lot more clear-cut. We don't have that transshipment problem. And therefore, I do think, relative to a number of our competitors, we do have an upper hand.
How long before we see a deal? Do you have a number in mind? How many days? How many months? With India, US?
No, I think the definition of deal is important. The trade negotiations run into years.
Yeah.
It's a deal on goods. It's a deal on services. This is going to take time.
But this is like the COVID emergency. We got the vaccine. COVID hit in Feb. We got the vaccine in November. So
the early tranche on some bits you could probably agree on by the 90-day. But the first tranche, of course, we are planning by September or October. The big deal, the real deal, is going to run into years.
It could be a MOU in the coming months.
The actual order will take time.
Well, interesting conversation there with the top brass at Nomura. Well, for the time being, we've got our pre-opened rates and markets have opened up mildly higher, but a lot of stocks moving around. We have Axis Bank, that's actually down close to around 2%. Midesh is back with us. Midesh, what's the 9-10 call?
I'll go with a buy on persistent for targets of 5 to 8.
Okay. All right. Got it, Mitesh. Thanks very much for that. Since you're talking about persistent, let's bring Rima back in. IT stocks in focus because we've got so many different earnings coming through. Rima, quick wrap up.
Well, I'm focusing on two of them, which you should watch as rates come in. One of them is Emphasis on the way up because it's a strong quarter. The company's reported its highest quarter-on-quarter revenue growth in 3 years. Top line growth stands at 2.9%. And to put it in context, most of the IT companies have reported a drop in their revenues in Q4. TCV, that's the total contract value of deal wins, was the highest in the last 7 quarters. Their pipeline is at a record level, and the company is pretty much maintaining margins. They ended Q4 with margins of 15.3%, and the full year guidance for next year is 14.75 to 15.75, and they expect growth to be above industry. So emphasis ticks, pretty much all the boxes. BFSI has done well for them, so that's a positive. Cyient, on the other hand, is a miss on revenues and margins. The company said that there were some programs which were stopped and deferred in Q4, which impacted them, and this might even impact their Q1 performance, which basically means that Q1 is also likely to be subdued. They haven't given a guidance for FY26 as they normally do, citing uncertainty. They say that the uncertainty is likely to last at least through the first half of FY26. And not just that, they've also lowered the margin guidance. So earlier their guidance was on margins 16% over the next 12 months. They're now talking about 15% margins over the next 24 months.
Okay, all right, got it. Thanks for that, Rima. Indeed, Cyient is a casualty, earnings casualty this morning. It's down about 5%. So is SBI Card, also down 5.5%. Abhishek is here with a bull versus bear argument on it. Abhishek.
Well, to begin with, Morgan Stanley has a bull case scenario, equal weight rating and a target price of 775 per share. Now, this target price has been increased by them. They say that credit cost and bad loan formation have declined sequentially, which indicates a potential stability going ahead. So, Q4 PAT was 15% ahead of their estimate. Lower credit costs are positive. The timing and normalization is still unclear, or, there is uncertainty over there. Bernstein has written on SBI Card underperformance rating, target price of 620 per share. They say that credit cost was all that mattered for SBI Cards moving into these quarterly results, and it has delivered a quarter wherein the credit cost has inched down sequentially. However, management made it clear that 6% to 7% credit cost that remains very far for them. So overall, sequential improvement is seen in credit costs aided by NII growth and an OPEX moderation, which helped SBI Card deliver an ROA of 3.4% and 15.5% in this quarter by them. Back to you.
Okay, Abhishek, thank you very much for that. We'll, come back to you with all these banking numbers, etc. as markets open. We've got a couple of seconds to go for the first rates. Nifty, sensex, bank Nifty, it's marginally higher, but nothing major at all. So 24,282 is where the Nifty is at, 0.15% higher. Bank Nifty is down about 1/3%, so that's interesting. Nifty Bank has, I think this is the, now it's flipped back into the green, but if it were to be down today, it'll be the third day that the Nifty Bank has been down. We'll see. Sensex is up about 0.3, the small cap index is up about 1/4%, and I think the mid cap index will come up on your screen as well. Give you a sense of how we are starting. 24,350 is where the Nifty is at now. It's about 100 points higher on the index. So firming up, absolutely firming up as we get into it. The Nifty heat map will come up on your screen. It'll give you a sense of how we are starting. And a quick snapshot view should come up in a bit. But let's get to individual stocks. Surabhi.
And earnings are driving big individual moves this morning. Prashant, if I look at SBI Life, 8%. That stock is soaring away in a big way because of that VNB beat. The VNB margin is 300 basis points above expectations, and it's also risen 200 odd basis points over the previous year. And the VNB growth also has been quite solid and ahead of street estimates. The street is absolutely loving it. In fact, it's rubbing off on HDFC Life as well. That's the second biggest winner on the Nifty, 2.5% on the upside. Now, I'll, however, flip it over to the disappointments. Axis Bank is selling off quite a bit. Axis Bank, though their margins improved, asset quality was stable, but the stock's reacting quite negatively, 3.5% down as we speak. Tech Mahindra, obviously, that top line miss the street doesn't like. 1.5% decline in constant currency revenue, more than what the street expected. Stock's down about 2%. So those are the sharp earnings reactions. Okay, now let's move on to the rest of the market. TCS up and about, Tata Steel, Shriram Finance, Maruti, these are your gainers. L&T. So some buying in auto. M&M is also higher. Maruti is higher. Maruti is reporting numbers today. There's Coal India, which is nudging some gains. JSW Steel, Hindalco. So basically, metals and commodities seem to be doing quite okay. HDFC Bank is up about 0.7%. ICICI Bank is up 0.5%. The Bank Nifty is absolutely flat. And that's because of the downward drift that Axis Bank and IndusInd Bank are putting on the index. So that's where the weakness really is. Otherwise, the market seems to be okay. Some little bit of buying on names like SBI, Trent, even Eternal I saw. Eternal is up about 0.5%. But the problem is Axis Bank and Tech Mahindra for the Nifty for the time being. Nigel.
Well, that's right. From the broader markets, you have an accident in Cyient. That's down close to 9%. So big downtick is what we're seeing out there. Vare Energies out there, there's a lock-in that's opened up. So, a lot of those shares are being eligible to trade. So that's why you have that stock that's down close to around 4%. Actually, from the lows, it's seen a bit of a recovery. So we'll keep an eye out on that stock as well. Sterling and Wilson, the stock is down close to around 2.5%. All these stocks highlighting them because they're moving on very, very large volumes. Patel Engineering, well, that's up close to around 5.5%. So big move out there. IEX, the numbers appear pretty much subdued. Remember, this stock has seen a sharp correction from the peak. So you have the stock actually that's opened up the gain of around 4.5% and doing pretty well on large volume. So good move is what we're seeing on that particular name. But clearly the casualty from the Nifty pack this morning is Axis Bank. The low of the day is around 1,160. It'll be interesting to see whether or not we see a bit of a pop from the day's low.
Speaking of casualties, we have lots of result casualties today. You pointed out Cyient, Nigel, which is down 9%. Look at L&T Tech, 6%. Look at SBI Card, down 4.5%, 5%. And then obviously Axis and Tech Mahindra from the large cap space. So lots of oops moments on the earnings front.
No, absolutely. And, Bari went up that 15% move day before yesterday. It's already given up 10% in the last, between yesterday and today, since the lock-in opened yesterday. So 27.34 on Bari. It's like yesterday, it's the number one volume-led sort of loser on the NSE. So a lot of volume action happening here. Axis is down 3. I think the bulk of it we've mentioned. Axis is down 3. Cyient, Loris, SBI Card, LTTS. Sterling Wilson Solar is down about 3%. I guess about E2E has got some volumes in it. Last 2 days, 5% every day. Syngene was the big loser yesterday. Syngene was down, I think, about 10% plus. It's down another 1.33%. Numbers were disappointing. Keynes, Bajaj Housing, K Fintech, Blue Star. Blue Star, by the way, was down 4 yesterday. It's down another 2. Actually, it's come off quite sharply, very, very quickly, right? And you'd think it's the summers. High is 2,100. Day before yesterday, it was at 2,100. It's at 1,800 now.
Down 10% this week, Prashant.
Yeah. There was that. Anyway, we'll talk more about this. Motilal is down about 2%. Reports numbers. Newgen is down about 3%. 361 ever since that deal was announced. Again, the high was 1,068, 1,070. Stocks at 990 now. This is the third day. So deal was announced day before yesterday. Spandana is down about 4%. Spandana had a decently large move yesterday on the upside. So just reversals across the board. And market breadth now a little firmer on the downside. So 1,300 stocks are down and about 850 stocks are higher at this point. By the way, Lodha is up 3.5%, and you'll hear from the management in about 10 minutes' time. So that should be an interesting one. Well, let's welcome in Rahul Arora of Nirmal Bang Institutional Equities. Rahul, good morning. Great to have you with us here. So what are you making of it, Rahul? It's every week is new and varied and entertaining, but prices have snapped back in a very aggressive way over the last 8-9 days.
Morning, Prashant. Thank you for having me on the show. Yes, I think the initial reaction may have been overstated on the tariffs. The pullback is equally surprising. I think what you guys were discussing before we just started our conversation is the reality. We are still in the midst of an earnings downgrade cycle. I think let's put it into perspective, Prashant. We're still in the first month of the fiscal. The whole year awaits us. Let's just break it down. I think if you look at banking, at best we'll do a 10-12% earnings growth this year. Consumer staples will be lucky to do that. Reliance will probably be around that 10-12%. And IT is a big question mark because I think we'll get more clarity in the Q1 results about how the year is likely to shape out vis-a-vis what we've already seen. My sense is this is 75% of the Nifty. I'd be surprised if this 75% gives you 10% plus earnings growth for this year. The balance 25%, even if it grows at 15%, just on a weighted average basis, you'd be lucky to get to a teens earning growth for FY26, which basically means you are still, as I said, in an earnings downgrade cycle. Now, the point is, at 27,000 Nifty, the valuations were at whatever, 23, 24 times. It dropped down to 18, 19 times, depending on where you were. But I don't think the extent of earnings cuts has been factored in. So it is very possible that in a month or two from now, the valuations, even if they're at 24, start looking very similar to what they were on 27 because the denominator gets cut to that extent. I still think that this is a great rally, honestly, to be selling into. There is no justification for it to have bounced back. I think pretty much everything that the market wants to know, it knows. It knows that the worst of the tariffs is behind. It knows the Fed will probably cut another 50 bips. It knows the RBI will probably cut 50 bips. The US yields have factored that in. The Indian bond yields have factored that in. The one interesting thing, Prashant, we were looking at the data for the last 10 years of which asset classes deliver the best returns. And for as much as people diss gold, 7 out of the last 10 years, it's been in the top 3 in terms of best returns of asset classes. And 4 out of the last 10, it's actually been the best performer. So I think even from an asset allocation standpoint, a little bit of movement into the yellow metal may not be a bad option at this stage. So
even now, after a 35-40%.
Yeah, so we actually hosted the World Gold Council executive strategist for our institutional investors just after the tariff announcements were made. And he felt that gold could return 15-20% this year. It's up about 8-9%. So you're still talking about a 10% plus growth. Now, superimpose that, can you potentially get 10% on the Nifty from here, which is basically taking you back to new highs? So that's the call you have to take. I'm not saying go all in into the yellow metal. I'm just saying that some amount of diversification, given that valuations don't look as cheap. You were discussing Blue Star. Look at that. Just look at that space and where valuations had gone.
Which is why, Rahul, and now what you're saying, we've actually, in the last 24 hours, 3 or 4 market commentators have made that point as well. Vikas Jain's call this morning, the CLSA call, was exactly that India is benefiting from the TINA factor. Flows are coming in, but the earnings reality is something that people have perhaps ignored. I remember Dheeraj Agarwal from Ambit making that point on the show earlier this week as well. So that question, I mean, what is the earnings reality? And with that in mind, would you expect the market can at least get back to the previous highs? What is the upside from here?
So at the outset, Surabhi, let me tell you, I'm very shocked to see that the market is where it is. So if it goes to new highs, I'll be even more shocked. So let's just, it's as simplistic as that. Like I was telling Prashant, I don't think the earnings reality is more than, you'd be lucky to get to a teen number. And I think even if you look at banks, which is the big elephant in the room, I don't think you'll get to a teen number even in FY27. Now, in that backdrop, keep aside IndusInd because of what's happened. If you look at Kotak, ICICI, HDFC, they're all back into that 2.5-3 price to book. Now, for the ROA and ROE profile that they have, this is more than price to perfection. If you're going to look at growths of 10-12%, why should you be paying more than 2.5-3 times price to book on FY27 when you're sitting at the start of FY26? So it is going to be challenging. But then, as you said, if flows keep coming in, it's what took the Nifty to 27,000. I think the tariffs were just an excuse, Surabhi, to reset valuations on the way down. So while the movement may have seemed exaggerated on the tariff news, the stock prices were not misbehaving irrationally. There was a genuine reset required. The market just latched onto that piece of news to reset valuations to a very large extent. That being said, I still don't think they are anywhere close to favorable in consumer staples, in IT or in banks. I think in all these three, then you cannot give a screaming buy. IndusInd seemed like a no-brainer after the news because the valuations had dropped to rock bottom and the bank was not going anywhere. It was one, news item or whatever for the size of the bank. But those kind of trades will be few and far between. This rally has been led predominantly by banks, if you see. So the question, I would be more positive on the FSI space, not the B space. So I would look at auto finance, I would look at life insurance, I would look at general insurance, housing finance companies. So anything NBFC, because growth is still there, valuations are not cheap. You were discussing Maruti's numbers today. Take a look at when Chola's numbers come in today. They'll be growing 25-30%. So then they will get the valuation. It's as simple as that because market wants growth. So stocks may get mispriced on the way up as well. Look at what AU Small Finance Bank did. Remarkable set of numbers. So in an environment like this, if you have companies that are growing in the FSI space, you don't have to be overweight the B. You can sort of be neutral to underweight and go slightly overweight on the other aspect, is the way I look at it.
All right. Hi, Rahul. Good to hear your thoughts this morning. And clearly, you're sounding a little bit cautious, actually, because earnings are not going to pick up. You've seen a good run. And as you said, maybe this rally could be a good one to sell some stocks into. That said, do you believe that the lows for the year are done? Or do you think we can go ahead and revisit that? Because the globe is still in a flux. And earnings are unlikely to pick up to those mid-teens at least in this year. So do you think we revisit the lows?
I don't think we'd revisit the lows, Nigel. I think that the low that you had of about 21.7 or thereabouts, that will hold. Okay. I don't think we're going to break that. Now, can you retest it? India has gotten into a bit of a tussle with its neighbor in the last couple of days, so we don't know how that's going to pan out. That's an overhang on, whether there is a market risk associated with that. I was just reading Trump has put a couple of days back 3,521% tariffs on solar imports from the Asian region. So if these kind of irrational statements keep coming out, you may have, gyrations on either side, but I don't think there is a reason to retest those lows. But even if you do, I don't think they will break. So I personally think you're probably going to be in a situation where you'll take out this year in a broad range of 22 to 25,000 on the Nifty. You're at the higher end, which is why I said it's probably not a bad time to be taking money off the table. That being said, it's not all gloom and doom. There are still pockets where money can be made.
So give us a couple of those top buy recommendations. And as you said, you're splitting it up between the B and the FSI. So that's one space you like, the FSI. But if you had to give us a few stocks, top 2-3 stocks that y'all as a house are looking at?
So I think, Nigel, if you look at it top down, I think the only two sectors where we can, apart from the one that I mentioned on the FSI side, the only two where there is revenue growth and visibility is consumer discretionary and defense. Mm-hmm. Rest, nothing else seems like it can potentially give you that kind of returns from a growth and evaluation perspective. So within the FSI space, like I said, AU Small Finance looks good. Chola looks good. Max Financial looks all right. Mm-hmm. Even something like a Lombard or a Star Health. I think that, those are some of the stocks. Muthoot also could potentially be looked at. So I think those are some of the names on the FSI side. On the consumer discretionary, I think Alcobev is going to do really well. I think you've had a good run in UB and UNSP in this rally. Both are up 15-16%. But my sense is that they could still reset another 20% from here. Chalet Hotels looks interesting. We've obviously been positive from Indian Hotels standpoint for a while, but I think on a relative valuation. And in defense, we had upgraded Solar about 2 months back. The stock's done really well in the last 2 months since that upgrade. So I'd probably be forced to downgrade that to a hold, but because valuations, I've seen some of my competitors have initiated at 70p. So, that tells you that you're in irrational domain when you're valuing capital.
Which is this?
Solar Industries. So, but I think solar is a good structural play. Hindustan Aeronautics. I think the one thing, if you look at the last 2 months, if you combine Army, Navy and Air Force, there is really 1.5 lakh crores worth of orders that's been awarded. So I think, Hindustan Aeronautics would probably be our top recommendation.
Valuation still okay after the correction?
On a relative basis, yeah. I think in order of preference, I think MDL also goes up there and we could even look at a BL or a BML. I think these would probably be the stocks that would probably do well. And from private sector, if you will, probably something like a Data Patterns, but not much else to look at in defense. Because I think all of these companies that I mentioned, we're reasonably confident of them growing between 18 to 25% on our numbers. And they'll have about a 300 to 500 basis point swing on the ROE and ROC. So on that backdrop, we're fairly comfortable sort of buying into these stocks and sectors.
Well, I recall we had the management of Solar Industries when it fell to around the 9,000, 8,500 level. And Mr. Manish, I think he joined on the channel and he said, no, we're confident that we will grow at the clip that the street is expecting.
This is the Pinaka orders, right?
Among others. Amongst others.
By the way, on a lighter note, today is a Friday. Movies, right? Do you guys know what movies coming out today?
No, I don't even know.
I know that Kesari.
Oh, I know which one. This is the friend mentioned this. Andaz Apna Apna is re-releasing. See, all these kids from the 90s, all of us would know about this.
It's an iconic one. I don't know if you just...
it's so funny that this movie actually bombed at the box office when it released. As did Agnipath.
Epic of our childhood.
There were so many of these movies that became cult classics later. But I think that's, when you talk about retail, I think it's an interesting one that you raise because, we do get asked this a lot as to why, retail and movies are struggling. It's a push and pull. Yeah. So most of these cinemas are in malls. So if the footfalls have dropped, it is going to have an impact on retail. And similarly, if people are not going into shop, they're not going into watch. So it's a push and pull if you see, and both are actually struggling. And if you see even in QSRs, dine-in is struggling, but delivery is not. So I think there is a genuine challenge getting people out of their houses. It is getting seen, and you've seen how Trent's numbers have, the way the stock price has corrected as well. So
last Sunday I was in Phoenix Mall, and which is a low parade for those who are not familiar with Bombay. I mean, I don't have planning to watch a movie, but I had 2 hours to kill. I had to, so I went to PVR, saw a movie, an English movie called Sinners. No comment about the movie, but it was, I think occupancy was not even 20%. It was a Sunday. And Sundays at one point it used to be, you'd struggle to get a ticket. It's a decently rated movie on IMDb, etc. So I don't know. I mean, some of these re-releases maybe do better, especially because
I think you guys
content has become an issue, and I think the one thing that has changed, and I think that's the reason PVR stock hasn't done too much, is this release window between theatrical and OTT.
Yeah.
So it's now down to what, 6 to 8 weeks, I think, somewhere around that. People are, unless it's, like for people who have kids,
larger than life
like you have a
content,
Titanic or an Avatar or a Bahubali kind of movie or a Sholay kind of movie, which you have to take in the cinematic experience. People are okay waiting. And I think, I was just reading somewhere, of course, this may not apply to the mass it may not apply en masse, but Suits is coming back through Suits LA now, with Harvey Specter back. Now, if somebody is a fan of that, now just imagine the binge watching. I'm just giving you an example. So it's content. Content
I didn't
is
know
not just
this.
getting.
This is a good cue.
So content is not just getting rehashed on cinemas, but even here. So that's probably the only part of consumer discretionary that we'll probably be underweight on, which is the movie space. But who knows? I think
I watched Interstellar last, and I think now this is going to be.
I think you guys should watch Raid 2 next week. If you all want to go, we can go together. And I'll tell you, Raid 2. Raid 2. And I'll tell you all in the break why I'm going to watch it.
He has to say all in the family. There's a disclosure.
Since we're talking about movies, I'm going for sure.
There's a famous line in Khalnayak, right? All in the family. That's what he's going to tell you in the break.
All heart.
All right, Rahul, fabulous conversation as always. You've lightened up our Friday. Thank you for stopping by.
Thank you for having me.
Though, of course, the caution on the market is, of course, very well taken. The market, for the time being, holding on just about 40 points up on the Nifty, but the mid-cap index is sliding. Bank Nifty also under pressure, down about 0.3%.
Well, that's right. Well, let's get straight to the next management we have on the show. That's Macrotech Developers. The stocks on our radar, the company reported a pretty good set of numbers, actually. The collections rose by 26% on a year-on-year basis, along with a healthy surge in the profitability. They have guided for around 21,000 crores of pre-sales in FY26. To discuss this and more, we're now joined by Mr. Sushil Kumar Modi, the Executive Director of Finance at Macrotech Developers. Hi, sir. Good morning. Thanks a lot for joining in. The street likes your numbers and the guidance they've given as well. Before we get number specific, tell us on ground, have you seen any kind of slowdown in terms of demand? Have footfalls reduced? Or is demand as strong as, say, what we saw 3 or 4 months ago?
Hi, Nigel. Good morning. Hi. Nice to be on your show. So, as you can see, the last year number itself speaks about the structural strength of our industry and the branded participants in the industry, how the consolidation is playing out, and which is where you would notice that we have outperformed all the metrics on our guidance, be it the pre-sales, which has grown by 14% this quarter to 4,800 crore. And for the year, we delivered 17,600 crore, outperforming our own guidance of 17,500. Embedded EBITDA margin on the pre-sales also came out at 33%, again outperforming against our guidance of 31%. Thereby, the embedded EBITDA on the pre-sales turned out to be 5,900 crore, delivering 35% growth. So, again, if you take it on the business development, we guided 21,000 crore. We outperformed significantly by around 12%, delivering 23,700 crore across 10 projects and obviously across the 3 cities that we operate in. So net, and as you rightly said, the collection represents the execution capability. The pre-sales is one, but the execution capability converts those pre-sales into the hard cash, and that is where our operating cash flow was dot on guidance, delivering 6,500 crore. And if you relate this strength of the operating cash flow and combine alongside the fact that we did significant business development, thereby meaning a significant investment, our investment this year was 7,000 crore plus the construction cost of 4,200 odd crore, means income total 11,000 odd crore of investment, yet we could deliver the very conservative capital structure where the net debt to equity is at around 0.2x, significantly below our guided number of 0.5x. And this is what has kind of enabled us to get to the credit rating of AA, which is at the beginning of the year we were at A+, and now we are at AA by CRISIL. So net, the trajectory of our business in the full year, we are pretty much on track, and that is what has given us the confidence in terms of, as you pointed out, guiding for the next year, growing by 20% to 21,000 odd crore.
Yeah, I'm looking at that guidance, 21,000 crores in pre-sales. Your launch pipeline is 31 million square feet, gross developmental value of about 18,800 crores. Give us some sense also of pricing, Sushil, and margins, because in Q4 your margin improved quite a bit. I think I'm just checking the numbers. I think it came up to 28%, if I'm not mistaken. 28.9%, that's almost 29% margin as you've ended the year. Is this sustainable? And, does the market have some room, some scope for price hikes?
Hi, Survi. Morning. No, you are right. So as I said, we delivered our embedded EBITDA margin on the pre-sales at 33%, and so is our guidance for the next year to be 33%. And this is pretty much in line with what we have, time and again said, that we look for delivering 30% plus of the EBITDA margin. And our industry and the product is such where a reasonable price increase is always being appreciated, be it by the existing owners of the asset or the new buyers, because so long the price growth is more like below the salary growth of the consumer, it only enhances the affordability metrics, right? And which is where the demand gets consummated, which in any case is is structurally very strong. So we clearly see that so long the price growth we carry to the tune of 5, 6, 7%, knowing well that the salary growth in any case in our country is more like 8 to 10%. That kind of only entices the demand to consummate, because people find it affordable to consummate their basic necessity, which is housing. So yeah, thereby as you have seen, be it last 3 years, year on year, we have maintained the trajectory of price growth in the ballpark of anywhere between 5 to 6%. We clearly see that similar thing happening, in the upcoming year as well.
Morning. So you're saying price growth of 5 to 6% possible?
Yes, Prashant. Yes.
Okay. So you put out all the numbers, etc., and we can talk more about that, Sushil. But there are two players who are very, very aggressive in the Mumbai market now. Actually, new players. One is Adani. They're buying up a lot of land parcels, very aggressive. And the other, of course, is Prestige, again going full tilt. Could you give us a sense of how this is likely to change the landscape? I mean, will it still be volume-led push in terms of growth, or will you recalibrate that a little bit as things go forward? What's your sense? Will it be more consolidation and kind of sort of protecting your margins, or will it be full tilt on volume growth?
Prashant, you rightly used the phrase consolidation. So our industry, post-COVID is seeing a dual consolidation, actually. Be it on the demand side, where consumer having burned their fingers big time in the pre-COVID era, buying from tier 2, tier 3 developer, the entire saving potentially has got lost, never even delivered a product. So the consumer in any case is now absolutely gravitated towards only buying from a top-notch brands. That's one. And so is on the supply side. So, even the land effectively end up going to the top-notch brands like Lodha. So these kind of consolidation on both front is not really been seen across many industries, perhaps to my knowledge. So you can see in any city that in our country, across the top-notch brands are performing good. The people going from one city to another city, that will be an ongoing affair, and obviously that every participant will have different strategy in terms of growth, how many cities that they want to operate. in our mind, the business is, reasonably regional, and thereby, we should be going more and more deep into any city that we choose rather than being wide across lot many. So yeah, more the participant that come into any particular geography, and so is, as you know, we have gone to the Pune and then to the Bangalore, right? So that only leads to the consolidation effectively is strengthening more and more. By now, perhaps the consolidation in the industry has already reached to around 30%, and there is no reason that it should not go towards 50% plus in few years' time.
Sushil, one more question specifically on the Mumbai market, and this stems from a note that Nuvama put out, not on you actually, there was a note on your peers, Oberoi Realty, and Nuvama was pointing out the risk of high inventory and whether inventory can be liquidated quickly enough or not. Give us just your overall, pan-India inventory position right now and the estimated timeline for liquidation. And in Mumbai itself, is inventory pile-up becoming an issue?
So actually the situation is quite reverse. We, in our industry, typical gestation period to deliver a project, is anywhere around 3.5, 4 years. And the situation has come to the extent that the inventory levels across top 7, 8 cities has gone down to below 2 years. Mumbai, perhaps it will be more in the range bound of 15 to 18 months. And so is the journey in, other cities. So really challenge is that, the inventories is only depleting, and obviously we will not be able to comment about any specific participant, how the inventory level with those participants are. But as we know, as a city level, the inventory level has gone down significantly, and which is where the consolidation comes into effect. Because now, from a new supply standpoint, when you look at how the industry is playing out, effectively, perhaps the consolidation in terms of the new supply has gone beyond 50% already.
Sushilji, very quickly, you're not sounding too perturbed with regard to demand, but where is demand better, mass or premium?
See, Nigel, this is across, right? Because housing at the end of the day is a necessity. So, obviously the affordable and the entry-level segment has somewhat got impacted in last 18, 24 months because of the rising interest rate, where we know the repo rate has gone up by 250 bips odd. So to that extent, the entry level did got suffered, but which is where the tailwind now, right? So as the reverse trend on the interest rate has commenced and the 50 bips has already gone down, and perhaps maybe another 75, 100 bips, whatever comes, that will only lead to strengthen this segment of the market, which was so far kind of not fully getting unfolded, and which is where Lodha gets an edge, because we are the only participant who perhaps cater to the entire segment, be it the entry level, mid-income housing, to the premium housing, to the luxury housing. So the business model of ours being so diversified, in terms of the audience, the segment that we cater to, the various locations that we cater to, we delivered 17,600 crore, but more important is we delivered from 642 odd locations, which means on an average, an individual locations effectively delivers 500 odd crore of sales. So that means we are neither dependent on any individual segment, nor are we dependent upon any city, or nor are we excessively dependent on any location. So that brings the resilience and the robustness of the business model that we have, and which is what then gives us the confidence, in spite of whatever global macro playing plus and minuses we reckon that. But nonetheless, we feel that our resilient business model should be able to deliver 20% growth in terms of the pre-sales in the next year.
Absolutely. Sushil, take your point. Diversification, always a good thing. Thank you so much for joining in. Have a good day and good luck with the year that we are in now. Okay, as we move on, now let's take stock of a story that was flashing on the screen just a while back. You saw those ticker lines on rare earth magnets that we are importing from China. And it seems China is putting certain new or additional regulatory requirements for sending those magnets to us. Let's go across to Parikshit to figure out what this is all about and whether it impacts the EV ecosystem. Parikshit, what is this story all about? Tell us more.
Well, we hear from sources that the EV ecosystem in India, component manufacturers have already started getting impacted. They are facing production challenges. This is because these rare earth magnets are a very critical part of traction motors, which go in electric vehicles. So what exactly happened is this. the Chinese government, effective from the 4th of April, has said that every company which is importing these rare earth magnets from China must get an end-user certificate. And that end-user certificate has to be given in a prescribed format. This will, first of all, mention that the magnets will not be given to any third party without the consent of the Chinese government. Secondly, they will not be used for making any weapon systems. And thirdly, they must have a dual authorization, not just from the foreign ministry of the Indian government, but also from the Chinese embassy here in New Delhi. So this seems to be a clear non-tariff barrier, which complicates things for OEMs. They will have to get these documents notarized. They will have to go to several levels of approval. We believe that the auto industry and auto component manufacturers have already reached out to the government for help, including the Ministry of External Affairs, and different nodal ministries for the automobile industry are looking into this matter, including the Ministry for Mines, Ministry for New and Renewable Energy, Ministry of Heavy Industry, and all of this is being discussed at the highest level because clearly if this problem festers, then there could be a slowdown in terms of production and more production hiccups in the EV industry along the way in the next few months.
All right, Parisha, thank you very much for that. So that is the overall sort of China, the trade tensions. And I mean, a lot of this will happen with regards to individual components and a lot of this, of course, will be posturing, etc. as well to be able to arrive at specific agreements down the road. So fluid situation, 70 points lower, by the way. And this is, I guess, this seems more, what we have in the market now with a 60-point cut seems more natural as opposed to a 100-point gain today. Even with the 2.5% pop that we saw last night, it just didn't feel, right opening up 100 points. But we'll see if things recover once again as we head into the rest of the day, into the weekend as well. 24,200, 24,183 is where you have what you have on the Nifty at this point. We take a quick commercial break here. We're going to come back and put the focus on the auto space. Sud will tell us the expectations from auto companies, and we'll get into a discussion with the analyst from Macquarie. Stay with us.
Welcome back. Well, let's put the spotlight on Quarter Se Quarter Tak, our special segment where we prep you up for earnings from different sectors. The sector that we're putting the spotlight on today is the auto space. So Darshan is here with the curtain raiser.
So the Indian auto sector has faced a turbulent FY25 with overall sentiment subdued, particularly during the second half of the year. Macroeconomic headwinds, uneven rural recovery, regulatory challenges and shifting consumer preferences have all contributed to the sector's volatile performance. For the last quarter of FY25, that is Q4, divergence in growth projections is becoming increasingly evident, with estimates ranging widely from a modest 2% to a robust 23%, reflecting varied expectations. Let's begin with the reported volume numbers across key categories. On a YOY basis, tractor sales have emerged as the biggest outperformers, aided by relatively stronger rural demand. Earlier in the year, however, on a sequential basis, the same tractor segment has witnessed the sharpest decline, indicating weakening momentum and seasonal moderation. Excluding tractors, most other segments have posted modest year-on-year growth. Two-wheelers and three-wheelers have seen low to mid-single-digit growth YOY, with sequential declines driven by soft rural demand, higher base effect and limited festive tailwinds. Passenger vehicles and commercial vehicles, in contrast, have reported sequential growth, with PVs benefiting from strong demand for SUVs and new model launches, and CVs gaining from infra construction-related activities. On the revenue front, the overall sector is expected to post around 10% YOY growth. In Q4, however, as with volumes, the revenue performance will be far from uniform. The two-wheeler segment is expected to show the widest range in performance, with estimates varying from 2% at the lower end to 23% at the upper end, depending on product mix and pricing power. Four-wheelers are projected to deliver double-digit growth supported by a strong mix of premium and mid-segment offerings. Notably, tractor segment is expected to outperform on a revenue basis with an estimated 20% YOY growth, largely driven by pricing actions and earlier demand strength. Amid this uneven landscape, certain players are expected to emerge as outliers in terms of performance. In the two-wheeler space, TVS Motor and Eicher Motors are likely to surprise positively. TVS is benefiting from urban recovery and premiumization trends, while Eicher continues to gain traction through Royal Enfield's steady domestic and export performance. Amongst four-wheelers, M&M stands out with its strong SUV portfolio, robust order book, and agricultural equipment division contributing positively. Within auto ancillaries, Samvardhana Motherson is positioned to be a sectoral outperformer aided by global diversification and increased content per vehicle. From a valuation standpoint, the sector appears relatively attractive. With a few exceptions, most auto companies are currently trading at or below their 5-year average price to earnings multiples. And as far as stock performance is concerned, except TVS, Eicher, Maruti and Ashok Leyland, all the companies you can see on your screen have given negative returns in 2025 so far, with biggest declines seen in auto industry names on the back of global uncertainty. Let's wrap with the outlook. In the near-term, outlook for the sector looks optimistic. The anticipated implementation of the 8th Pay Commission and income tax reliefs are likely to aid the growth for two-wheelers and lower and And for the tractor segment, Met Department has predicted above normal monsoon for current year, and that is likely to boost rural income, leading to an increased demand.
Okay, all right. So, Darshan, thank you very much for that comprehensive wrap. So that's how we're, looking at the Q4 season for the sector. Let's take the discussion forward with Ashish Jain, India Mobility and Materials Analyst at Macquarie Capital. Ashish, great to have you on the show. Thanks for joining in. So, in a broader context, this is a market that's hungry for growth. And largely speaking, the auto sector has not delivered large parts of the sector, barring stocks like a Mahindra and Mahindra. And then we've had brief flashes of a great rally, let's say on a Bajaj Auto. But otherwise, growth seems to be missing. Do you see that changing anytime soon? Let's start with the PV space, where I don't remember. I mean, we've been looking at anemic single-digit to flat trends for the longest time.
Thanks, Obi. Thanks for having me on the show. Like you rightly said, fiscal 25 has been a tough year for PVs. We started off on a slightly weaker footing. We did see a very solid spike during the festive, the 20-25 days of festive, and then things have been southward after that as well. But I would want to contextualize this. If you look at the longer-term growth rate for PVs in India over a 3-year, 5-year time frame, it's been in the range of 5 to 6% CAGR. And some of the slowdown that you saw in fiscal 25 is also because the preceding couple of years were very, very strong. We witnessed 15%, 20% kind of growth post-COVID. And if I look at the data, from let's say fiscal 19 to fiscal 25, we have grown in term with the longer term trends of 5 to 6% growth. So honestly, some of the growth slowdown that we saw, was expected. Yes, it is further accentuated to some extent with slightly weaker demand in the entry segment, which I think is partly a function of income levels, with the entry level customer. But yeah, I would say F25 has been a bit muted, but not very disappointing versus what we were factoring, at the start of the year.
Ashish, on PVs, barring Mahindra and Mahindra, it's been an outlier, best in class. But barring this one today, for instance, Maruti reports numbers, as Hyundai as well. Would you be willing to, look at a buy on any of these stocks, hoping for a revival or a turnaround? We all spoke about this 1 lakh rupees in the hands of the common taxpayer at the end of the budget, but it needs to show up in numbers, and so far it hasn't.
Right. So, I would approach it very stock by stock. On a top-down basis, we still think fiscal 26 will be low single-digit growth for PVs. We are factoring around 3 to 4% growth for the industry on an overall basis, and that does factor, like you said, some benefit of the income tax cut. But within that, we still like Mahindra and Mahindra. It has been our top pick, and we think it will continue to benefit from model cycle tailwind, which has been quite favorable for them. And now even EVs, EV launches will also add to their volume growth. And in addition to that, M&M also has a tailwind from fairly strong tractor cycle as well. So M&M is what we really like in the PV space as of now.
All right. Hi, Ashish. Good morning. Good to see you on the channel, and thanks a lot for joining in. We have a couple of other sectors of interest as well, like materials. But for the time being, let's stick to autos. We have another IPO that's coming in from the EV space. That's Ather. We know what happened with regard to Ola. There was a lot of interest, and then investors, they bought the brand because things didn't really pick up. Now you have another IPO that the street is looking forward to. A relatively smaller player, but financials are relatively better, I would say. Your take on the IPO, what kind of valuations should investors be looking at? Do you think it'll be far better?
Yeah, thanks, Nigel. Thanks again, and good to speak to you. So clear, honestly, valuations and all is something I would refrain from commenting, but do want to make a couple of points here. One, Ather in the last few quarters have seen fairly strong traction with some of the new launches. If I look at the Vahan data for April month, which is a publicly available data, their market shares have improved to around 14-15%. So clearly, they are seeing strong traction, and we did, kind of attend their analyst meet. One of the very interesting points which the management said is currently nearly 2/3 of their volumes are coming from South, versus around 1/3 for the industry. And going ahead as they expand into other regions, their distributions into the other regions, they expect to kind of do well from a volume point of view. So I would honestly leave it at that as far as Ather is concerned, given we are not kind of covering the stock at this moment.
What about other two-wheelers, Ashish? I was looking at the price on Bajaj Auto. It's come off significantly, right? From levels of 12,000 to now, I think last we checked it was, we're talking 8,100 this morning. That's a 35% decline from the peak.
Yeah, so in two-wheelers, our top pick has been, TVS, and we continue to like TVS. They have gained market share in scooters, in motorcycles. Exports also have, recovered quite strongly for TVS. And I think it's one company where, in spite of whatever commodities are doing, we are convinced of a margin expansion. So that remains our top pick. Coming to Bajaj, I think two things have happened for Bajaj. One, the traction for their CNG motorcycle has been slightly subpar versus what we were factoring at, at the time of launch. And secondly, even in 125cc, which remains, a very compelling segment for Bajaj, we have seen heightened competition with production normalizing for Honda. So there also they have lost some market share. Having said that, we like their traction in e-two-wheelers. They have done really well to scale up volumes. They're now the sector leaders. So I think, near term Bajaj stock could remain range bound. Also, one thing from an export point of view, if you look at the recovery in exports, TVS actually has done much better than Bajaj in terms of the trajectory of recovery. So there has been some disappointing on CNG and exports, partly offset by strong traction in e-two-wheelers. But yeah, we'll stick with TVS for now as far as our two-wheeler pick is concerned.
Okay, so TVS in two-wheelers, M&M in four-wheelers. I go back to that growth question, Ashish, just in terms of a pickup, and we've not even discussed CVs because, again, I don't remember the last quarter, we really saw a move on the CV cycle with the Ashok Leyland's numbers. Stocks completely sort of gone off the radar. Do you see any of these pockets turning around soon? Tractors, absolutely, and tractors have started showing that pickup, which is why M&M is your top pick. But apart from, M&M and tractors, anything else?
Yeah, so if you look at Vahan data for April, it's just like 3 weeks into the year, but still, two-wheeler is showing a decent recovery, on a month-on-month basis. So I think that's the positive sign. Again, too early to call out a full year thing, but for the full year, we are factoring around 7-8% growth for two-wheeler. And we also believe that two-wheelers will be the bigger beneficiary of the tax cuts that goes effective April this year. So we are quite constructive on that space, like I said, led by led by TVS. And as far as, CVs are concerned, last year was a bit lackluster. I think first half, the bases are low. So that would make the headline numbers look decent for CVs. But yeah, on a full year basis, we are still sticking to 1 to 2% kind of growth for CVs as a segment. And with commodity doing what it is, we could also see some margin pressure at the margin. And hence, clearly CV is not something which is our focus at this point of time.
All right. Got that. Thank you so much for joining in, Ashish. Good conversation. That's the auto space. But we need to look at the overall market. Look at the market-wide slide. Now, India today, this morning, is standing out as a sore spot in the global context, because global markets are soaring. The Japanese market 2%, Hong Kong over 1.5%. China is also up 0.25%. And we are underperforming in a big, big way. So this heady rally that we've seen from the lows, it seems there's a hectic profit taking that's underway. And it's market-wide, like I said. It's across sectors. It's across market capitalization. The mid-cap index is now sliding 2.3%. And it's become one of those mornings where the advanced decline ratio is extremely, extremely weak. Let's pull up mid-caps and the advanced declines. You only have 220 stocks advancing in the market at this point in time. Big slide. Let's get the crisscross lines in. So, yeah, it seems, Prashant, maybe, I don't know, book profits, had a great rally, take it home, enjoy the weekend. Monday ko dekhenge. Is that it?
I think so, Surabhi. And there is this, I think there is a real sense of trepidation about what may happen because of the Pahalgam attacks as well, right?
Yes.
Will there be military escalation, etc.?
Yeah.
So many people that I've spoken with off the air have asked me whether we are hearing something.
Yeah. Yeah.
And we had Parikshit, of course, sort of with information about what the government is, on what lines the government is thinking about. So there is that. But even, and we, by the way, came into this very, very unfortunate event with the market, which was already up some 12-13%, in the prior 7-8 trading sessions. So, prices have snapped right back with no real visibility of earnings improvement or anything. So it's a combination of things. It always is. But we are now down about 300 points or so. Mitesh is with us to run us through just the price action and what he'd do now. Mitesh, your sense?
Yeah. So, Prashant, I was talking about the fact that with the GIFT Nifty going up, we might not get an intraday decline today, but that's actually happened. Given the fact that we are heading into this strong support zone of around 23,900, 950, I think this is the area where you would want to venture and take some long positions, slowly accumulate from these levels till about 23, about 920. So you have a 40-point window to slowly accumulate long position on the Nifty, and keep a stop just below levels of 23,850. So that is the way I'll approach it. I think this is the dip. See, we were quite overbought, and there was always a chance of it coming down. But only thing is that we don't know which day it will happen. I think it's happened today, and now is the time to slowly get into long positions on the index as well as stocks. So that's the view on the Nifty.
And you're saying, Mitesh, this thesis holds. I mean, you take a long trade till 23,850 holds, right? That's so your
23,900 to 870 is my support zone. So I'll keep a stop about 20 points below that and slowly accumulate from these levels all the way down till about 23,920.
Okay, so that's the index strategy. What about stocks, Mitesh?
So on stocks also, given the fact that there are stocks which are giving pullbacks, I think this is the time, where you would want to explore and get into some long positions. Disclaimer, we have a position in Mahindra and Mahindra on the call option side, so there's a bullish bias, but this is the dip you would want to buy. Keep a stop just below levels of 2820, so about 32 points from here, and look for a target in excess of 2950. The other one which I am looking at is Steel Authority. Steel Authority has also come back from the recent swing highs of 119, 120, around 114, so about a rupee lower from here. Buy with a stop below 112 for a first target of 120, and if we start closing above that, then we can look at even higher levels.
Okay, all right, got it, Mitesh. Thank you very much for that. We need to head into a quick break. Come back on the other side, and we'll have lots more lined up for you. Back in just a moment with all the stocks on the move.
Okay, welcome back. 260 points lower on the Nifty is what you have. 23,990 at this point. That's a sectoral watch, and mostly everything is down between 1% to 3.5% odd percent. And the media sector is, of course, very small as in terms of capitalization. But look at healthcare, real estate, those are bigger sectors, and there you have 2.5% cuts. Axis Bank reported numbers, stocks down about 3-4%. Abhishek is here with a recap. Abhishek.
Prashant, to begin with, they saw a weak business momentum on a YOY basis. So deposit growth at 9.8% YOY is the second lowest in last 16 quarters, but 7% quarter-on-quarter is the best in last 8 quarters. Advances growth were weak at just 7.85% is perhaps the lowest that you are seeing on a YOY basis in last 16 quarters. Sequential growth was just 2.5% over there. So weakness was seen in couple of portfolios like housing finance as well as auto segment for them. Cost to income ratio is at 5-quarter high of 47.8% versus 46.2% in the previous quarter. The good part in the result was the asset quality. Slippages declined on a sequential basis by 11.5% to 4,800 odd crores versus 5,400 odd crores in the previous quarter. Asset quality improved thanks to high write-offs. The write-offs in this quarter was the highest in last 16 quarters. So gross NPA ratio came down to 1.28%, which is the lowest that you are seeing in last 39 quarters. A risk-weighted asset to advances ratio, that's the highest in last 5 quarters, meaning that risk in the balance sheet has been built up slightly. So it was at 111.4% versus 109.8% in the previous quarter. P&L with reference to our poll, the NI was in line with our poll, and thanks to lower provisioning, the PAT beat our poll. Back to you.
Okay, all right. Got that, Abhishek. Thank you very much for the details over there. On that note, we'll move on, take a quick break, come back on the other side with our special segment, It's the Economy. Lata will be in conversation with Krishna Srinivasan of IMF on the steep cuts to Asia's growth forecast by the IMF.